Hey, how's it going, everyone? Bill Lethman here for Money Evolution. In this video, I'm going to be walking through another hypothetical case study. So if you watched my last case study, you know that one focused a little bit more specifically on some of the Roth strategies that we do in some of our high-end financial plans. And in this video, though, we're going to take it right from the top and walk through the entire financial planning process that we do for our Money Evolution financial plan. So in that last case study, though, we were able to, through some of those optimization strategies, help that hypothetical client save over $643,000 in total taxes over their lifetime. And not only that, but we were also able to help them increase their total portfolio assets over their lifetime by over $1,600,000. So as we work through some of the details in today's case study, I think we're going to find some very similar results. But again, we're going to be walking through the entire process from beginning to end so you can get a firsthand look at the financial planning process that we do. Now, when we get into some of this financial planning, we generally have a few goals that we want to try to accomplish throughout the financial planning process. Goal number one typically is just to get organized. So if you're starting to think about this a little bit more seriously, one of the things you may be wondering about is how do I just kind of get my arms around all of this stuff? You've got lots of different accounts potentially. You've got different resources, things like Social Security or maybe pension benefits. Maybe you've got some employee benefits. Maybe you're planning to buy a second home or sell a business. So those are some of the things we're going to get into in today's case study. But really, we need to have a system to kind of bring that all together. And that's the first step in the financial planning process, to bring this all together. We're going to do it through some very sophisticated software that we use. It's the eMoney Financial Planning module. It's the advanced planning module of that program. And getting organized, number one. Number two is we really need to start to get a good, accurate map of your cash flow. Now, if you've ever done one of those more basic financial plans that was more goals-based, you might have put some inputs in and maybe it spits out some results and say, hey, you're in great shape or you're right on track for hitting some of your long-term retirement planning targets, but it really left out some of the details that you maybe were looking for. Well, that's where the cash flow based financial planning really comes in and mapping those cash flows. You can see year by year what money's coming in, what money's going out, plan for some of these kind of one-off expenses. Maybe you're planning for a wedding or a big trip, or you have some major home remodeling that you're going to be doing, or paying for kids' college. So really getting that accurate map, and especially as you go into retirement, that's going to be even more important to really understand what your gaps are so you can start to plan for some of your retirement withdrawals and creating that retirement withdrawal strategy. Then we're going to also work on some optimization strategies. So what's the best way to utilize all of those different resources that you have? Things like Social Security, when's the best time to turn that on? Should you take a lump sum pension or should you take a monthly pension option? If you're selling a business, what's the best way to structure that? What are the potential capital gains that you may be faced with if you sell that business or you sell another piece of property that you have? How can we best optimize your savings? There's a lot of different options today of contributing money to a Roth or contributing money to a traditional retirement account. A lot of that really kind of goes into the tax planning that we're going to do inside this financial plan, and really understanding where my tax bracket is today versus where that tax bracket is going to be in the future, so you can really optimize that. And then even doing some asset shifting. So if you've got money in those three buckets that we talk about, the non-retirement, the traditional, and the Roth, how can you best optimize that? And can you be potentially shifting assets from one to another? A lot of times that's done through Roth conversions and things like that. And really putting this all together and getting that strategy for what you're going to basically get out of the financial planning process and how do you best optimize all of these different resources. So let's go ahead and jump into our hypothetical case study here. And we're going to be talking about Michael and Sarah Davis. So they are obviously a hypothetical couple. And as we're going through this scenario, of course, it may not necessarily match up exactly with you and your situation, but hopefully by the end of this, you'll get a pretty good idea of what the whole process is about and how we walk through the steps of the financial planning process here. So Mike is 55 years old, and he's an executive for a Fortune 100 company. And Sarah is 56 years old, and she owns a marketing agency that she plans to sell at retirement. They have three kids. William, who's 22 years old, just graduated from college. Emma is 18, and she's a freshman in college. And Carson is their youngest. He's a senior in high school, and he's 17 years old. So one of the things we're going to be talking talking about as far as the goals for Mike and Sarah is doing some college planning. They've put some money away in some 529 plans, but it's probably not going to be enough to completely cover their college expenses for their kids. But they want to see how that looks as far as if they continue to fund that after those 529 plans exhaust, funding that out of their regular cash flow there. So Mike and Sarah, they've got some very nice portfolio assets, just over $7 million in total investable assets, and that's going to be split, as we're going to see here, between some non-retirement, some traditional, and a little bit in some Roth. Like a lot of our clients, we tend to see the majority of people's financial assets in those traditional retirement accounts. And that's, again, one of the main reasons for doing a lot of this planning is that could be, in some cases, a ticking tax time bomb, where as that money continues to grow, hopefully over retirement, once you get to retirement and those required minimum distributions, how that is affecting your future tax rates there. So we're going to talk about that in a little bit more detail. So their goal, again, is to retire in 5 years, just after Carson is expected to graduate from college. Again, they want to pay for some college expenses. We'll look at the 529 plan. And then at retirement, Sarah is going to try to sell that marketing agency. Right now, she has a key employee that is saying that they want to buy the business. So we're going to talk about that and whether she sells that in a lump sum or tries to maybe do that with a note receivable and then receive some ongoing income from that. We'll look at some different options there. And they also have a goal to buy a home in Florida. So they're kind of looking ahead a little bit to their retirement. And right now they're in the state of Pennsylvania, but they want to get someplace that's a little bit warmer, maybe, at least for part of the year. So they want to look at next year potentially buying a house in Florida. And they want to look at what that is going to do to their assets and to their future expenses and things like that. They're not sure yet if they're going to sell the home in Pennsylvania and then move permanently to Florida. But one of the things they are thinking about is potentially making Florida at some point, maybe after retirement, their primary residence so they can avoid the Pennsylvania state taxes and go to Florida, which is currently an income tax-free state there. So we're going to be looking at all of those different goals here for Mike and Sarah. So up here on the screen, we're going to get into a little bit of the software here. And again, the first step of this is really getting organized and putting it all together. We do that really through a net worth statement. So if you've never done a net worth statement, this can be something done on your own, just as simple as putting it together, with a spreadsheet, or even just as simple as a pen and a pad of paper to really just kind of take inventory of all the assets here. And again, this may not necessarily look exactly like your situation, but we're going to go through this here. So again, we separate this into a couple of different buckets. Non-qualified assets, those are things like your cash accounts, money markets, and also any taxable investment accounts. Things like they have a dividend portfolio here, and they also have some joint investment accounts and another taxable investment there. So about $2.8 million in those non-qualified assets. They also have quite a bit in some retirement assets there. So Mike has a rollover IRA account that he had from a previous job, $712,000. His current 401k is currently sitting at about $1,875,000. And then Sarah has a 401k plan through her business that's $1,342,000. And then they do have a little bit of a Roth conversion account there, just about $300,000 in that Roth account there. So most of it, again, is in those traditional retirement accounts. Mike also has a deferred compensation plan because he is an executive at that company. And right now he's got about $276,000. We're going to talk about that a little bit in deferred comp. That's another way that you could do some asset shifting, or income shifting, I should say, where you can lower your taxes currently if you're maybe going to get up into a higher tax bracket that you don't want to be in. You could have that come off your paycheck and then be taxed on it later in retirement. Generally with deferred compensation plans, they might have some options for how you take that money at retirement. I think in the plan here, we assumed that Mike was going to take that out over a 10-year period and distribute that as income in his early retirement to kind of help some of the cash flow there. So their total retirement assets are about $4.5 million. And again, their total liquid assets or investable assets is $7,372,000. Sarah has a marketing agency right now. She's thinking that it's got a value of about $600,000. So we're going to talk about that, and if she sells that into retirement, what that looks like here. And they currently have their primary house, which is $1,750,000, and then just some personal assets there, a Jeep, some personal property, and a Tesla there as well. So those assets total just under $10 million, $9.9 million. They do just have one outstanding debt, and that's their primary mortgage, $326,000. So that's our net worth statement. That's the first step in any financial planning process, is just kind of inventory all of the different assets that you have. Next, we're going to go over to the cash flow report. And this cash flow report is really going to be the centerpiece of the entire plan. And it's really going to kind of encompass everything going on, money coming in, money going out throughout the life of the plan, your time between now and retirement if you're still working, and then what that looks like as you go into retirement here. So up here at the top, we can see a couple of graphs that give us a pretty good idea of what's going on visually with the Davises here. On the left here, we've got this inflow and outflows, and the red line is money going out, the green line is money coming in. And so we're going to see, as we go through some of the details of this, we see that red line spike up. I think that's where we put in the potential purchase of a home in Florida. So we've got some accounting in there for a down payment that they're going to pull out of their investment assets to cover that, and then a little bit there, maybe some college expenses and things like that. That big green spike up is going to be the sale of Sarah's business. We're going to get into the numbers here in just a minute, but this is a good way to just visually see what's happening with your cash flow here. And if you see those little spikes and things like that, it kind of just brings attention to it, and we can go into the plan and say, okay, hey, what's going on there? I don't remember what that was from. We can go into the numbers. One of the things I want to point out here is this period right here. Now, if Mike and Sarah do in fact retire in 5 years, they'll both be in their early 60s. So Social Security won't even be eligible to collect, and maybe for another year or two. And then in the plan, we're going to assume initially that they're going to wait till their full retirement age for that Social Security benefit, but they're going to have some bigger gaps early on in retirement. And then we see once that Social Security benefit starts to kick in, we get a little bit closer with that green line to the red line. And then the really big jump here is the required minimum distributions. And so that's something that technically is a withdrawal from the portfolio, but it does show up on the positive side of the cash flow statement there. So that big increase there. And we're going to talk about that a little bit more. And we want to maybe bring that down a little bit and maybe control some of the taxes from those required minimum distributions by doing some Roth conversions or some other asset shifting strategies there. And then on the right, probably the most important graph in the entire financial plan is basically a projection of what is going to happen or what could happen hypothetically to their portfolio assets over time. Now, most of our financial plans, I think all of them pretty much, we use some very conservative growth rates. So I think here for Mike and Sarah, we did the same thing. I think we've got the portfolio assets growing at just a little bit over 5%, 5.09% to be exact. So we're not basically building the plan out saying this is all looks great, but you got to make 7, 8, or 10% per year to make this happen. So we want to be a lot more conservative with that. But those assets still look very good. The assets are growing throughout retirement, even though they may be pulling some money out of those assets. So what that says is that if Mike and Sarah wanted to increase their spending, maybe take some more trips or, maybe spend a little bit more money on that Florida home, whatever that may be, there's definitely some room there to have some extra cash flows going out, and their assets would probably still look pretty good. So that gives us a quick visual representation there. And then down here, we start to get into some of the numbers. And so working from left to right, we've got the year, of course, we've got both of their ages, and then everything from the center line to the left is all going to be money coming in. You can see they've got some pretty good income, $420,000 coming in from the business income from Sarah, and then Mike's salary and bonus from his job. We also have some business income from Sarah's business. So she's making, in addition to her salary, maybe taking out a little bit of an owner's draw out of that of about $50,000 per year. So that's in there. And then we can see coming out at retirement, the potential sale of that business there, $693,000. So we did inflate it. We said her business was worth $600,000 today, and just based on some inflationary growth, maybe that would be close to $700,000 by the time she retired there. And then basically inflows minus outflows equals our net cash flow. So we can see, like for example, this year, they have a positive cash flow of about $100,000. Next year, because they're buying that home in Florida, they have a cash flow deficit of about $308,000. So we're going to get into all the details of that in just a moment here, but that gives us the quick overview. We can also kind of scroll forward to retirement, and we can see what some of those cash flow requirements are going to be based on their spending needs and what money may be coming in at that time. They can look at what that cash flow withdrawal might be, or the retirement plan withdrawal might be in those early years of retirement, and how that kind of evolves over time. So as we look at this, there's a lot of detail here, but we can actually get into a lot more detail kind of behind the scenes there. So if we say, okay, that income flows column here, and basically any of these columns that are highlighted in blue, we can actually click into that, and then we can see where all of that money is coming from. So we have Mike's salary and bonus of about $330,000 per year, Sarah's salary that she's taking from the business of about $90,000, and then we can see how that may grow over time. And then at retirement, Mike's going to have a pension coming in for 2029, about $36,000, almost $37,000. We did add an inflation on that pension. Most pensions don't have an inflation rider attached to it, but a lot of government pensions do have that, where the pension will actually go up a little bit over time. But keep in mind, most pension plans probably don't have that inflation factor in there, but Mike's does in our hypothetical example, of course. And then the far right column here, income flows, all that stuff is just going to simply get added together and netted out there. We can go back to our cash flow. And then we can hop into any of these other columns. We did say that Mike and Sarah had a dividend portfolio. So one of the goals is for those dividends to, for now, until now in retirement, have those dividends reinvested and grow that portfolio. But then at retirement, start to draw from those dividends and use that as another source of retirement income. So one of the things that we have the option to do is we actually excluded that particular account from the liquidation strategy. In other words, as we start to build that retirement withdrawal plan, the plan won't go to that particular account for withdrawals. It'll kind of protect that. And so those dividends there, we can see what that is, maybe $32,000 as they go into retirement, and then it goes up a little bit every year just with some of the projected growth of the account. The other thing we can see here in plan distributions is we see that 10-year period where Mike's going to be getting his deferred compensation withdrawal. So again, you have different options typically for those deferred comp plans, and you can maybe have it pay out entirely at retirement. I would be really careful about that, because if you have a lot of money in that, it could be a lot of taxes all at one time. And you might be able to do 5 years or 10 years or 15 years. I've seen all kinds of variations of it, but we'll put that in there for the 10 years, and that plan is going to be liquidated over that time. I think the way we have it in here right now, Mike's still contributing to that deferred comp plan, so that I think it was $276,000. That's going to continue to grow with the contributions and hopefully some projected growth in there as well. And then the other thing we see here in plan distributions is their required minimum distribution. So they just made a rule change to that at the beginning of this year. So now if you're born before 1960, your required minimum distribution age is age 73. But if you were born in 1960 or later, that's going to be age 75 or greater. So Mike and Sarah both were born after 1960, so their required minimum distributions are going to kick in. Mike's a year younger, so we can see in 2042, when Mike turns 75, $294,000 is going to be his required minimum distribution. And then the next year, when Sarah turns 75, that's going to jump up to $473,000. You can see these numbers just start to get pretty astronomical there. In fact, actually, if they live all the way into their late 90s, it's going to be over $900,000 for just their required minimum distribution, almost $1 million. So again, that's one of the things that we talk about a lot, and we definitely want to address. And that's probably one of the most common things that people come to us to do the financial plan, is to say, hey, I'm concerned about how much money we have in all of these traditional retirement accounts. And if you just do some simple doubling of money, using something like the rule of 72, if you double your money, between now and retirement, and then retirement and age 75 or whatever that may be, maybe even using a 5 or 7% growth rate. If you've got $2 million in an account right now, and that could be $4 million, and then it could be $8 million, and you could see how that could really kind of compound and what that means for those required minimum distributions. And we'll talk a little bit about forecasting future taxes or tax rates, which this does a great job at doing with the software here. But I can tell you, if you start having income just from one source, the required minimum distributions, and then on top of that, you have a Social Security, a pension plan, or whatever that may be, you can see that for the Davises, their income in the future down the road gets well above $1 million. So that's probably going to be hitting some of those higher tax rates for sure. Again, the other thing we have in here is other inflows. And that's going to be basically just the owner's draw or some extra income from Sarah's business there that will be coming into the plan, and then the sale of her business there in 2029. So right now we have it in there as basically just she's going to sell the business as a lump sum. So already I think you might be starting to get the idea of just how well this can organize. And if you've got some of these different things that are going on with your situation, trying to get your head around it, everything, and trying to plan it all out can be really cumbersome if you're trying to do that through a spreadsheet, or especially if you're trying to do it just on a pad of paper and trying to make some of these projections. This is all mapped out and happening for you. Also projecting inflation and future growth rates of your income, growth rates of the portfolio, and also putting into effect some of the tax rules and things like those required minimum distributions, and getting a pretty good idea of what is happening there with all of that. Now, kind of going over to the next section here, basically here we have total expenses and planned savings. So those are basically going to be the two things that are going to be money going out. And again, we can get into a lot more detail here with this. So if we just go into the total expenses, we can see a better breakdown of what that looks like here. So we have some basic living expenses. Typically for that, we're going to put in things like food and groceries, entertainment, dining out, travel expenses, car expenses, things like that are all going to be part of those living expenses. Typically, real estate expenses, we're going to isolate and put that into a different column. And the reason why we do that is, again, if you think about what we're trying to plan for Mike and Sarah, they currently own a house right now, and that has some property taxes, some insurance, some maintenance, and some utilities and everything attached to that particular residence. Then in 2024, we're going to show what that looks like if they added a second residence. We're going to add another real estate property there, and we can see their current house has a real estate expense of about $33,000, but then adding in that Florida residence, hypothetically, would add another $33,000 or $30,000 or so, and bring that total real estate expenses up to $64,000. So another advantage of having this isolated in a separate column is because of what we talked about earlier. If Mike and Sarah decide, hey, you know what, in 5 years or 10 years, we want to sell that Pennsylvania property, we can show that as a buy-sell transaction, show that inflow of capital coming into their portfolio from the sale as they net that money out, and then also show a deduction or basically the removal of those expenses there, so they don't have those cost of real estate fees anymore. So that's why we want to have that separated out. And all of this stuff is, of course, indexed for inflation. We also have some liability payments in here. So again, with that transaction that we did, we have the Florida property coming in next year in 2024 with a new mortgage. So again, we can put pretty much anything we want in here. We can say, I'm going to buy this property. Here's how much the property costs today. If I want to buy that in 5 years, we can show, through some inflation what that might cost to basically buy that same property that may have a cost of, let's say, $850,000 today, what that would cost if you bought it 5 years from now. And then say, I want to put 10% down, 20% down, 50% down, whatever that is. We can show that and then show that with a mortgage. So we'll talk about this a little bit more, but mortgage rates are obviously pretty high right now today as we are in late 2023. So I think we put this in here as a 7% mortgage. So that's just saying you're going to keep that mortgage throughout time. And but of course, if you refinance and had that loan paid off and you get it at a 3 or 4% mortgage, hopefully rates go back to those levels, that could be an advantage. But we're going to always try to tend to be a little bit more cautious on the projection. So if we're talking about an expense, we always typically want to maybe have that expense a little bit higher than what we might think it is. And if we're talking about an income and we think that income could be variable, we want to show that that income maybe at the lower levels of that range and everything. So we can see what that looks like there for the the mortgage and everything like that on their current home. So, and that was the other thing too. They wanted to pay their current mortgage off at retirement, so they didn't have that loan anymore. It's almost the situation where they can do that, where just through the regular payments and everything. We can also explore things like maybe doing extra payments to make sure that that property gets paid off at retirement, or we could just have it like we have here, which is a little bit more of a balloon payment, or maybe it's their own choice of a balloon payment where they're going to pay that off. So we can, like I said, pretty much model anything that we want inside the software. So again, living expenses, liability. We talked about real estate expenses, and then in other expense flows, this is really where we have some very good options here. So we have things like Emma's college. Okay, so she's in college right now, so we have some projected expenses there. They live in the state of Pennsylvania, and so we can pick pretty much any school that you want, in-state tuition or out-of-state tuition. The software has the database of, I've never found a college that it doesn't have in there. It's got pretty much every university in the country in there, but I think for here we put it as Penn State. And so Emma's got 4 years of that college, including 2023. Carson, that'll begin in 2024 and have 4 years of college. We can also see here too, because I mentioned in the opening that they have some 529 plans, and we can see a projected withdrawal from the 529 plan to cover that. So that's not going to get them all the way there. So we can see, for example, in 2025, they have about $80,000 of college expenses, and by that time, there's only about $24,000 left in those 529 plans. So the difference between that would be added to their expenses and then deducted from their cash flow. We could put it in here however you want. For some people, they might say, hey, we've got a 529 plan, and once that's gone, we're going to have them take out some loans or make them responsible for that. We can say when the 529 plan's done, we won't fund that expense anymore. We did put in here too a wedding, and I know they have 3 kids. We just put one of them in here. Again, hypothetically, we said William's going to get married in 2025, so we put a wedding cost in there of $31,000. You could do pretty much whatever you want. You could put future weddings in there, even with the 2 younger ones, and just for kind of hypothetical, you could say, we'll put it in there for 2030 for one of the kids, and then 2024, 2034 for another one, and just to have a place marker for those weddings. Most people probably don't know unless you specifically have something planned. They don't know when their kids are going to get married or if they're going to get married. So if you want to budget for that, we can throw something in there. But here we just have William's wedding just to kind of show what that looks like. So now the other thing we want to take into consideration are some of the healthcare expenses that they might have in retirement. So I'm not going to spend a lot of time on this, but typically what we've seen is that healthcare expenses tend to grow annually at a rate that's about 2 or maybe even almost 3 times the regular rate of inflation. So usually I think in the plans we're using about a 7% inflation factor for those projected healthcare expenses. And because Mike and Sarah are going to be retiring before they're eligible for Medicare, they may have to go out into the exchanges if they don't have an option for for healthcare coverage through, let's say, Mike's employer, for example, and that can be very costly. We're looking at maybe 37 or 40,000. We hope it's not going to be that high. We hope there's going to be some things that are going to come out that are going to make healthcare cheaper for all of us, but we definitely want to, again, be a little bit more cautious on the expenses, which means we put a little bit higher number in here than what we think may be the reality. And then we can see how that may come down once they become Medicare eligible, which we have here, maybe about half the amount for healthcare cost as they go into Medicare there. So you can see we could put almost anything we want into this other expense category. So if you have a big family trip that you want to budget for, and that may be $50,000, and you want to do that in 2027, we can put that in there. If you've got some home repairs or an addition to your house, we can put that in here. Pretty much anything you can think of. I've seen this where this ends up being where there's maybe 10, 12, 15 different columns as we're starting to budget out all of these different things and being very specific. Mike and Sarah, their kids are a little bit older right now, so they're in college. But what we see a lot of times for younger couples or younger people is that if they have younger kids, they may be active in sports and things like that. Or you may be paying for some private tuition for grade school or high school, for example. And those things are going to be expenses that aren't going to be forever expenses, but we can really map that out. We can say, okay, we've got Emma's soccer for these 4 years, and then after that, she's probably going to go to the high school team, and then she won't have that expense anymore, or whatever it may be. We can get as creative as we want with some of that. So if we go all the way back to the cash flow report here, again, we were just in the expense category, spending a little bit of time with that, and then we can also get into the plan savings. And so for them, we pretty much just said that they're both maxing out their 401k plan through work. They're $30,000 for Mike and $30,000 for Sarah. Wanted to look real quick here on the deferred comp plan because I thought we had put something in there for that. But let me just double check and see if we have a contribution here. And you get a little behind the scenes here. Okay, so we're going to add that in here real quick, and we're just going to say it's going to be a fixed amount, and we will put that in there at we'll just put it at $25,000 right now, and we'll say that will keep up with inflation, so we can see that. Okay, then we go back to this, and this is how easy it is to change. So sometimes when we're doing these financial planning meetings, it's going to be very conversational, and we're going to be looking at this, and there may be something that, hey, I forgot we are contributing to Mike's deferred comp plan, and we can just add it in on the fly. Or as we're working through details and things, we might decide that, hey, you know what, maybe we should be contributing to Mike's plan there. Let's throw that in. And so now we go back to that plan savings, and we can see what that looks like. He's putting in $25,000 into that deferred comp. So anyway, we can map all that out, and it's a great way to see all the different things that are happening here with the plan. We can also, and we're going to talk about this more after we get into some of the optimization, but we can start to look ahead and say, okay, at retirement, what are we looking at here? We put in some expenses that we think are reasonable. We've got that new Florida property, and with all the things considered, it looks like they're going to have to take out maybe about $150,000, $170,000. We kind of get that roadmap. This is what the required withdrawals are going to be for them to meet those expenses that they've outlined there. We can look ahead and see right here, that number comes down a little bit because Mike is turning 67, which is full retirement age. That's what we've assumed is the age that they're going to collect. We can play around with that a little bit too, but that drops a little bit there. And then this next year, we have two things happening. One, Mike is going to get now a full year of Social Security because in the first year, it was only partial year from his birthday through the end of the year. And then Sarah is also going to get a partial year of Social Security. And then what I like to do is look here, basically at the age or the point where they're both eligible for their full Social Security benefits, and that's going to be bringing that net cash flow down to about $60,000. So again, that's a very low number compared to the amount of portfolio assets that they're projected to have, which is going to be maybe almost $13 million. So we can go into the plan and say, hey, you know what, we really maybe didn't account for all of the spending that we want to do. You know, we've covered all of our base spending there, but we'd also like to, let's plan for some extra travel. You know, we're going to be retiring young and we want to travel the world, go to Europe, go to different things. And so let's throw in an extra $50,000 a year for travel. Or maybe they want to spend some time, maybe their kids are in different states and they want to spend some extended time in those locations with their kids and maybe future grandkids, whatever that may be. So there's certainly some room here with all of that. So that's their cash flow map. And I know we spend a lot of time with that, but that's typical of what we do in our financial planning meetings. We want to get that cash flow right. We want to get it all mapped out, make sure we didn't miss anything, or that we're really putting together the most accurate representation of what you think your retirement and your long-range plans are going to be. Because if we start getting some of the optimization strategies, which is what we're going to do next, then you might have to come back and say, well, hey, those optimization strategies really don't work anymore because now we're changing our cash flow model. So getting this right, I think, is very, very, very important. And you might be starting to get a sense as we're going through this as to how all those different moving pieces kind of interact with one another. When you change one thing, it's going to influence many other things. For example, we talked about maybe increasing their spending. So if we started working on, let's say, some Roth conversion strategies, and then we said, hey, you know what, really, we want to spend that extra $50,000 in retirement for some of that extra travel, well, that may change entirely whether or not that Roth conversion strategy makes sense. So we're gonna want to look at that. So let's look at a couple of other things here. We're going to look at a couple of other reports. And again, this is just going to be sort of a baseline of what we do in the financial plan. One of these is going to be our assets by tax type. So we can see a little bit of what's going on here. There's going to be three basic buckets. We've talked about this, or I've talked about this in other videos. The dark blue is going to be those taxable assets there, and things like your non-retirement money markets and brokerage accounts or investment accounts that are outside of your IRAs or Roth accounts. And then the light blue is going to be all of our traditional money. So that's money that's got taxes attached to it. And when you take that money out, whether you take it out or your spouse takes it out if you predecease them, or it goes to your kids and they inherit it, at some point, somebody's going to end up paying taxes on that money that's in those tax-deferred assets. And then for the Davises there, they do have a little bit in some Roth assets. They're not really contributing to those right now, but you can see what that looks like. And again, as we get into some of the strategies, we want to change up the makeup here. The other thing we can see here too, and I can tell right here where I've got my cursor, we see a lot steeper incline of those non-retirement assets or those taxable assets. And that's because their required minimum distributions kick in. And because their spending is, again, relatively low compared to what those required minimum distributions are, those required minimum distributions are actually just building up inside those non-retirement account assets there. So again, it goes back to what we talked about. They could spend that money, or we could look at some strategies to potentially bring that down. Now we're going to go into some of our more advanced features of the software and start to look at their tax projections here. So we're going to look at their tax bracket over time. And this is really where I think the software that we use really shines. Again, there's a lot of financial planning software firms out there that have some products. This is where I think the eMoney financial planning software really excels in the tax planning capabilities that we can do with it. So we can see over time, basically, while the Davises are still working, here's their income and their tax bracket right now. And then we can see something interesting happen is that later on, after those required minimum distributions kick in, we can see what the heck's going on here. We see much higher taxes, even higher than when they were working. But the other thing we see a bunch of these low tax years. That's something, again, I've talked about that in a lot of videos, and really almost everybody has, unless you're retiring really late, you've got really high levels of income going into retirement. Pretty much the majority of the financial plans that we do are going to have some of these low tax years. And that's going to be where we're really going to have some optimization that we can do. We can also get a little bit of a sense of where they fall in the tax brackets and things. So we have, for example, our income tax base. that's going to be things that are going to be taxed at your marginal tax bracket. And so the plan and the software is sophisticated enough to differentiate between, for example, what we talked about earlier, those dividends that we are projecting from that non-retirement account, those are going to be taxed at a preference tax rate. And there's going to be rules attached to that, depending on what tax bracket they're in, how much income they have. They could be taxed at 15%, or if they have, I think it's over about $550,000 of taxable income, they might hit the 20% long-term capital gain and qualified dividend tax rate. And they're probably, for the Davises, they're going to get hit with something called the net investment income tax. And that's going to be for people that have income over $250,000. There's going to be some of that investment income that's going to get hit with an extra 3.8%. So that's all going to be accounted for here within the software. If they're hitting those levels, it's going to be calculated automatically there, and even their state taxes too. So we, again, have the ability to put any state in the country into this, and it's going to do a pretty accurate representation of what those state taxes are going to be as well there. So we can see that income tax base, again, that's our marginal tax rate. Now their taxable income might actually be higher. I'll go into one of the tax reports here in a moment. But we can see based on this, they're going to be in a 24% tax bracket, and then tells us how far into the bracket they are, and it tells us if there's any money remaining in that bracket. Okay, and so for them, they have a little bit this year, $12,000, $43,000, and $46,000 in the next couple of years. And we see a big jump. So why is that? Well, in 2025, that's the last year of the Tax Cuts and Jobs Act rates. And then in 2026, again, all things, that, are supposed to happen right now, those current tax rates expire at the end of 2025. And we're going to go back to the old tax tables that we had in 2017 with a little bit of an adjustment for inflation. That's all being accounted for here, because if nothing happens, that's what's projected to happen basically with that. So again, it doesn't take into account any future tax legislation that may happen with Congress passing something. So that's why they jump up there, and they have a couple years of that, and then they're going to retire. And then we get these low tax years there. So they might be in a 33% tax bracket when the tax rates change for 3 years there. And then we see, wow, that's great. We're in a 10% bracket, a 15% tax bracket. And I see this a lot. I see a lot of people that I talk to or that come to us with some planning, and they say, hey, I've got a great tax plan. I'm not paying hardly any taxes in retirement. And that's because they're not really looking ahead to the future. They're looking at maybe they're living off of some of those non-retirement account assets, and maybe they're paying long-term capital gains taxes on or whatever, but their IRA accounts or their tax-deferred bucket are just continuing to grow. And then we can see what that looks like. And so once Mike, let's see, but this is actually, it starts to jump up here before even the required minimum distributions. Once they both start taking Social Security, now they're jumping up into the 25% tax bracket there for a couple of years. And then that really jumps up here to 28% when Mike starts to take his required minimum distribution. And then by the time they're both taking RMDs, that jumps up to 33% and pretty much stays at that 33% for the rest of their projection here. Now, again, there could be some new tax legislation that changes the 33% to the 38% tax bracket, but we're working with what we sort of know right now today. And so based on that, what we really want to do, our goal here is to smooth out some of those tax rates so that we don't have those ultra low rates and then get to the ultra high rates or to the higher rates. We want to try to say, hey, can we take advantage of some of these lower tax rates? That's what we're going to look at here as we start to get into some optimization. The other thing that I want to point out here too is some people, maybe there's two spectrums, the people that just want to keep their taxes low today and they're not really looking at the future, or some people say, hey, I really think tax rates are going to go up. I think that they're going to go sky high, and I want to just push all of that, maybe do mega Roth conversions and try to get all this money out of Roths or out of traditional into Roths, and they pay that at a 37% tax rate today because they're so concerned about higher tax rates, when the projections really show that, hey, maybe you're never really going to be in a 37% tax bracket. Maybe 33 is where that will top off. And even here, even with these 33% brackets, they're still according to our projections, maybe $100,000 or more of room left in that bracket there. So that's one of the things that's going to go into some of this planning, and then we can even get into just show you for a second here a little bit more detail of what the projections look like here. So we've got the gross income, the regular federal income tax, how much you're projected to pay, capital gains taxes potentially, and we can put all kinds of different assumptions in there based on what the makeup of your portfolios are in those non-retirement accounts, how much is dividend income, how much is capital gain, how often you're turning the portfolio over. Of course, you never know for sure what those taxes are going to be until you actually make those transactions and everything, but it'll give us a pretty good representation. And we go into other income taxes. That's where we're going to see the breakdown of the state taxes as well. So we have a pretty good idea here of what, they get a retirement income exemption and things like that they can use, and then what the total state tax is. And every state's going to be different for this, depending on what those individual tax rules are. And as we go into this column right here, regular federal income tax, we can see here a really detailed breakdown of what the taxes look like. And this is, again, why we have these conversations and people say, well, I got an accountant, I got a CPA, I got the best guy, girl in town, and aren't they going to do this for me? Well, the problem is because they're not looking at the totality of the entire financial situation and money coming in and money going out, planning the growth of the portfolios potentially with the required minimum distributions and Social Security down the road. They're not able to really give us that long range projection of what the tax rates are going to be in the future. They may be able to calculate it today, get a pretty good idea of what the tax rates are going to be now or in the next couple of years, but they're not going to really have that long-range projection here. So we can see adjusted gross income, and we can even go further into these columns too, but adjusted gross income, we see something here happening where the current tax laws that we had, the Tax Cuts and Jobs Act rate, basically about doubled the standard deduction and then took away our personal exemptions in 2026. When that goes back to the old tax rules, our deduction goes down, but we get some personal exemptions. The other thing that's happening here too is we can see now they're actually not just taking the standard deduction anymore. Now they're itemizing their deductions, and we can see there were some limitations on interest deductions from a home, as well as property taxes, the state and local tax. And we can see that their exemptions or their deductions are a little bit lower here. But when that reverts back, there's actually an advantage in that situation to the changing back to the old tax rules. So their deductions actually go up a little bit right there, and that's all being forecasted and accounted there. But they also get hit with a little bit of AMT. That's how detailed this is going to be there, where it's actually going to forecast if you've got some alternative minimum tax that's going to come into that. Okay, so now let's go back to our optimization strategies here. So we're going to go back into this planning center here, and we're basically going to look at a couple of different things here. We're going to look at one, taking a lump sum pension versus taking the monthly pension amount, so we can see what that looks like there. We can look at paying cash for their Florida home instead of taking out a mortgage, what that looks like. We've got some Roth strategies that we're going to take a look at, and then we also looked at here too, Roth strategies with a delay in their Social Security benefits, and then just looking at Social Security. So why don't we start with that? Why don't we look at just the Social Security, and we're going to see what that looks like. And I think here what we did is we just said, okay, what if they pushed their Social Security benefit collection date out to age 70 instead of taking it at age 67, which is their full retirement age here. And we can see once this loads, what that looks like here. And so we can see, based on that, there's really not going to be any benefit for them to delay to age 70. And again, that's another very common myth or thing that we see people coming into us talking about, is that, hey, I want to get the most I can get out of Social Security, so I want to delay it as long as possible to age 70. And in this case, it really doesn't add any value. It actually takes a little bit of value out. So it basically starts off, because you're not collecting it, you're having to take maybe more money from the portfolio assets. And then even though you might get more at age 70, it never really catches up. So again, every situation is going to be a little bit different. Again, it's why you look at the whole thing and you want to really have everything mapped out with the cash flow, because for some people, it may absolutely be the best option to wait till age 70. And for other people, it may make sense to just take it early, for example. So we can look at that. Let's look at the lump sum pension. So for a lot of pension plans now, they give you an option to take either a lump sum and then you don't get that monthly pension check anymore, or you can keep the monthly pension check. So again, we put in some hypothetical numbers here. Sometimes it works out more positively for taking the lump sum. Sometimes it works out a little bit more negatively. But there's always a very important decision. So if you take the lump sum, now you're taking the responsibility for investing that money. And of course, we've got market fluctuations and things that can go very good for the markets or things that can go very bad for the markets. But with a regular monthly pension check, you've got that at least guaranteed by the company and by the pension that you're going to get that same amount every month. So for taking the lump sum, we can see basically, these are the same blue bars from our cash flow report where we had the total portfolio. So if you take the lump sum, you're going to have more money for a while because you're getting all of that money into the portfolio. But then as time goes on, that starts to go down because you're trading that off versus the long-term pension. So we can see, sort of where that break even is. And so according to this, just with the numbers, assuming you can get a 5% growth rate on the lump sum, you're ahead of it until about age 91 or 90. And then after that, it starts to go a little bit negative. But again, with the lump sum, a lot of variables are in there. You could make more than the 5% and these numbers look even better, and maybe it'll look sky high all the way through the rest of your life. Or if we go through a series of bad market events, it could be quite a bit worse, even much worse than this. And you also have something called the sequencing of returns that really comes into play there too, where you could still average 5%, you could even average 7%, but if you get, in particular, some bad years early, that can really change things to be very negative. And let's look at the paying cash for the Florida home. And these are things that I've already mapped out and put into the software here, and we can see what that looks like. A little bit of an advantage here to paying cash for the house. Again, we put that in as a mortgage of 7%. We just saw that there were some added tax benefits from some of the interest that they were able to deduct from that home. And then there's also the possibility that if rates go down at some point, they may not be stuck with that 7% loan. They may be able to refinance it at 5 or 6 or 4, or hopefully get back to those rates again. But we can see pretty much anything that we want to model inside of this software here. And then where we want to kind of end up here is, let's look at some of these Roth strategies. And so we looked at a couple of things, and one is, we talked about this in the Roth strategy case study, and I'm not going to get into quite as much detail here, but just to give you sort of an idea, we talked about an after-tax savings option. So a lot of 401k plans offer this extra account that you can contribute to after you hit the 401k limits of $30,000 as it is right now in 2023 for somebody that's 50 years old or older, and you can go all the way up to a total of $73,500. And that's going to include that regular 401k, either traditional or Roth or a combination of it, plus any match that you might be earning, and then whatever that gap or difference is, you can go all the way up to $73,500. A lot of companies have this. I think it's been quoted that maybe close to about 50% of big companies have this kind of option inside their 401k plan. So if you don't know about it or you haven't looked into it, I would definitely try to check that out. And even though you may have $30,000 of eligibility, you may be still limited to something. I've seen it where some companies limit those after-tax savings to 10% of your salary, for example. So I think in this example right here, we did this and we said that Mike was going to contribute $23,000, which would be about 10% of what his base salary is, not counting his bonus there. And And then what we do is we map that in. So the idea is you can contribute to this after-tax account, and then periodically or once a year, or some 401k plans even just do it automatically, almost as the money is going in, you convert that to a Roth. And because it's contributed with after-tax dollars, there's no extra taxes on the conversion. You've already paid the taxes on that as it went into it. So it's kind of an automatic Roth contribution strategy. Now, we also talk a little bit about what's called a backdoor Roth, and that's where if you make too much money, and I think for 2023, the numbers, I had them written down here somewhere, I think it's about $238,000 if you're married filing a joint tax return. But anyway, if you make too much money, you're not going to be eligible to make a contribution directly to a Roth IRA account. However, anybody, regardless of how much money they make, is eligible to contribute to a traditional IRA account, and that would be made with after-tax dollars. And then anybody, regardless of income, now can do a Roth conversion. So you can contribute money to a traditional IRA account and then immediately convert it over to a Roth. And that's kind of a backdoor way to get the money into the Roth if you're over the limit. Now, one major caveat to this is something called the pro rata rules. If you have existing IRA accounts, then even if you contribute that money to a brand new IRA account and then convert that, the IRS looks at it as you have one collective IRA account, regardless of whether it's all in one account or you have it in several accounts or however that is. And so because Mike already has an existing IRA account, he's got that rollover account we talked about earlier, he would not be really eligible for doing this backdoor strategy, or at least if he did it, it would not accomplish what he wants to do, because they're going to look at it and say what portion of the total in IRA money would be non-taxable and what portion would be taxable, and it would get really messy and not accomplish what you want to do. Sarah does not have an existing IRA account. She just has the 401k. So we have this backdoor Roth modeled in here, and it's not a huge difference here. It's just $7,500 a year. But again, it's a little bit of what we call asset shifting. You're going to be taking money from some of the non-retirement assets, let's say, and then moving that over to Roth by contributing to that Roth IRA account. So we can turn some of these off, and we can see just the impact of certain things on their own. And we can see, okay, just those, just Sarah's backdoor Roth, for example, $7,500 a year for the next handful of years before retirement ends up increasing their assets by $75,000. It's not a huge number in the percentage terms, but it's still very nice. Who wouldn't want that? For some reason, it does make their taxes go up a little bit, so we'd have to look into that and see why that is. If we put Mike's after-tax savings in here, let's take a look at that. Yeah, so that's increasing his total portfolio assets by a little bit. And then, but sometimes when we combine these things together, we see a much different outcome here. So if we put in all of it, including the Roth conversions that we're going to put in, we do two things. We're going to increase the total assets over their lifetime. This is about almost $1,500,000, $1,483,000, and we lower the total taxes over their lifetime by $1,042,000. And we played around with this a little bit, and we looked at different targeting different tax rates and things like that. So we could say, okay, if we just went up to the 10% bracket because there's some low-hanging fruit, or we do the 15% bracket, we can see what that looks like there. But here in the plan, we're actually targeting, I think we did the 28% tax bracket. We went a little bit over in a couple of these things, not by a whole lot there. So even though we targeted 28, it went over a little bit into the 33% tax bracket. That's something we can refine and work on in a little bit more detail. There must be some other income that's kind of kicking into the hypothetical situation here. But we can see what that looks like with the long-term Roth conversion. So even though they're still working right now, there still may be some opportunity to do some of these Roth conversions even right now while they're still working, and then in the first part of retirement. Basically, we ran this out all the way until their required minimum distribution age. But we can see by kind of piling or stacking some of these things on top of each other what that looks like in terms of optimizing or doing some asset shifting there. So that looks very good. We can also get a little bit of an idea here too with some of the estate planning. So many people are interested in not only just maximizing the taxes for themselves and the long-term asset portfolio, but also, hey, if I want to plan for this to go to my kids in the next generation, what does that look like as we start to work on some of these strategies here? And so this is going to do a calculation of their estate taxes and the taxes on any money that might be left in some of those traditional retirement accounts. And so using some of these strategies, it actually lowered the taxes and expenses by $1,678,000, and it increased the total amount to heirs by $3,161,000. So again, I know this is just a hypothetical case here, and it may not exactly match up with what your situation is, but as we work through these strategies, they are not at all uncommon as far as being able to work through and best optimize all of the different resources that you have. And then once we've done that, and again, we may continue to refine this if we were working on this as your individual financial plan, but we can look at, okay, now that we have some of those optimization things in there, what does that look like as we go into the cash flow? So if we start doing some Roth conversions, what that's going to mean is we might have some bigger gaps early on, and we're going to see that showing up in the cash flow. So that may be some extra accounting that we need to do there. We can even be as specific here as going in and saying, what are the income taxes if we do those Roth conversions? And we can say, okay, let's just look at early retirement here. So we'll look at 2031, we have $122,000, write that down, $122,000 in total taxes with those conversions. And then if we go back to our base facts, we can see in 2031, well, look at this. We had about $9,000. So again, we're paying taxes on a lot more income, but we're also doing that shifting so that we don't have to pay the higher taxes later. So some people might get a little sticker shock and say, hey, that's a lot of taxes. That's another $110,000 in taxes that I have to pay there. But again, it's really doing two things. One is it's going to lower the future taxes that you're going to have to pay during your lifetime, and it's also going to lower the amount of your taxable estate. So as it is for Mike and Sarah, with their projections, they're actually probably going to get into a point where they might have some estate taxes because they're going to be over what those limits are likely going to be. Again, tax laws can change, but they're likely going to be over those limits. So you're doing actually two things there. And you're also giving yourself some protection against two other things. One is that new tax legislation comes out and raises the taxes pretty much across the board, or maybe puts in some kind of an excise tax or something that says, hey, if you've got too much money in an IRA, we're going to tax it even more. You may think that sounds crazy, but that actually existed. There was an excise tax on what was deemed to be too large of a distribution from a retirement account from 1986 all the way till it was repealed in 1997. And it was your regular taxes, and they were much higher tax rates then than they are today. And on top of that, you were potentially hit with this 15% excise tax on some of that distribution. So, so it's a very real possibility. $33 trillion in national debt and huge deficits that are just growing by the second here. That's something that would be definitely an advantage of doing that. And the second thing there is that, God forbid, something happens to you or your spouse. Right now, we're running these projections with you on a joint married filing joint tax return. If you only had one of you and you had to go to that single tax return, you're going to have mostly the same amount of income. Your required minimum distributions, for example, aren't going to really change at all, but now you're going to be hitting those higher levels of taxation at lower levels of income. Okay, so just a couple more things as we wrap up the case study here. I'm going to go back to that assets report here, and we're going to look specifically at the assets by tax type, and then we're going to compare it to what we just did with some of those Roth strategies here, and we can see what the the long-term impact is. And oh my gosh, wow, that looks fantastic. So basically, in our first example here, we had very little in our tax-free bucket. We had a lot more in the traditional, and then we actually had another problem sort of creeping in where, because of those large required minimum distributions, that taxable base was actually growing quite a bit. So what we did was we kind of kept that a little bit more even-keeled throughout time, but now we created a much bigger portion of their financial assets that are in that Roth or tax-free bucket here. So that looks great. And not only is that number much higher than this number, but it's also a much, much better makeup of that. And then lastly, we'll come back to this cash flow. And I won't spend a ton of time with this, but this is where we really start to get into mapping out the withdrawals and setting up the accounts for that retirement withdrawal strategy here. And we're going to go into our Roth strategies because that's what we want. We want to use those. And again, that's going to mean that maybe we've got some bigger gaps to cover. And so where this is going to really kind of drive it home makes sense is really knowing what's happening year by year. So for example, if they want to buy that house in Florida next year, they're going to be running into about a $358,000 cash flow deficit. So my rule of thumb generally is to keep at least 2 years of cash flow needs liquid in something like a money market or something very safe, bank accounts, things like that are very liquid and not subject to market fluctuation, so that you don't have to run into a situation where, oh my gosh, the market's down 20% or 50% or whatever it may be, and that money we had for the house is not there anymore. So you want to keep that separate. So we're looking at maybe about $430,000 if I'm kind of adding that in my head roughly there for the next couple of years. We also have a couple of cash flow shortages here in these years, partially because the tax rates are going back up. So they're going to have some higher income taxes that they're going to have to contend with there. We could look at things like increasing Mike's deferred comp plan. That could be something that could try to bring that down a little bit. So there's other things that we could get into there. But higher tax rates because the current tax rates are going to expire. And they also have some of those college expenses. Once those 529 plans are exhausted, they may be dipping into their own investments to cover that a little bit there. Then we see at retirement, we see what that looks like for the first couple of years. So they maybe have about $500,000 of cash flow liquidity needs in the first 2 years. So they want to keep that very safe and liquid. Generally, then I'm going to recommend for most people to have another 5 years of cash flow needs and something that's still going to be on the safer side for investments. That could be bonds and CDs, things like that are again not going to fluctuate a whole lot with the financial markets, but they may need another, just adding that up, it might be another $800,000 or $1 million that they want to have in something safe. And the idea is that that's going to create a little bit of a buffer so that if or when we go through those market declines, you're not having to sell those equity positions at a loss, hopefully, and you can ride through a downturn in the market, and maybe some of that cash reserve kind of gets depleted a little bit, and hopefully by the time that goes to zero, the market has had a chance to recover, and you can take that out. So there's a lot of different strategies there, but that kind of paves the way for it. But the number one thing to really do or know is what are those cash flow gaps? Because if you don't know what the cash flow gaps, then it's almost impossible to really build that retirement withdrawal strategy. And so that's going to really kind of lay it out there. And again, there's a lot of moving pieces here with a pension that's coming in, some dividend income, the deferred comp plan, and again, your situation is going to have probably a lot of those same moving pieces, or maybe you've got different moving pieces, but whatever they are, we're going to be able to put that in here. And that's pretty much it. So hopefully that gives you a pretty good of an idea of what the whole financial planning process is about. So again, we call it the Money Evolution Plan. There should be a link, I think, in the description below, or right on the page here where you can set up a free introductory call with me. We can hop on a call, talk a little bit about your situation, see if this is something that may be right for you, and maybe how we would apply our financial planning process to what you're currently doing. And so I would click on that button. I would love to have a chance to chat with you about that and see if it's something that's right for you. Until that, have a great rest of your day, and look forward to hopefully hopping on a call with you. Thanks.